The recent fluctuations in the US dollar have sparked significant discussions, especially in light of the latest Consumer Price Index, CPI data released on Tuesday. Following this announcement, the trade-weighted US dollar experienced a decline of approximately 0.5%. This downward trend persisted over the next couple of days, culminating in the release of producer price inflation figures yesterday, which were notably higher than analysts had anticipated. The increase was recorded at 0.9% compared to the previous month, a figure that took many by surprise, as none of the nearly 50 analysts surveyed by Bloomberg had forecasted an increase exceeding 0.4%. This unexpected surge in producer prices likely served as a reminder to the markets that the recently implemented tariffs could indeed have an inflationary effect on the U.S. economy, as pointed out by Volkmar Bauer, a foreign exchange analyst at Commerzbank. Looking ahead, it appears that the U.S. dollar may face mounting pressure in the upcoming months. It is quite surprising that it took the PPI figures released today to trigger this realization, Bauer remarked. After all, core inflation had already slightly surpassed expectations on Tuesday, revealing some concerning trends within the data. For instance, when we examine the momentum of core inflation, specifically the seasonally adjusted 3-month change annualized, we observe an acceleration from 1.7% in May to a current rate of 2.8%. This indicates that in recent months, there has been no clear sign of a sustained downward trajectory towards the Federal Reserve's target of 2%. Furthermore, the modest rise of only 0.2% in the core goods subcomponent may seem to suggest that tariffs are not significantly driving price increases. However, this interpretation can be misleading. Excluding the aftermath of the last inflation shock, this was the highest increase recorded in July since 2001. Historically, the annual rate of change in core goods prices has remained below zero for more than half of the months since 2001, indicating that goods prices typically trend downward. In contrast, it is often the services sector that propels inflation. Therefore, it is particularly alarming that the annual change in core goods prices reached 1.2% in July, marking the highest level since 2011, aside from the inflation spike following the pandemic. So, does this imply that the Federal Reserve should tread carefully before deciding on an interest rate cut in September? Likely yes. But will they choose to keep the key interest rate steady in September as a result? Probably not. This very inconsistency is expected to exert increasing pressure on the US dollar in the months to come. It's important to note that the information presented here contains forward-looking statements that carry inherent risks and uncertainties. The markets and instruments discussed are intended solely for informational purposes and should not be interpreted as a recommendation to buy or sell any assets. Conducting thorough research is essential before making any investment decisions. FX Street does not guarantee that this information is free from errors or inaccuracies, nor does it assure that the information is timely. Investing in open markets involves substantial risks, including the potential loss of all or part of your investment, as well as emotional distress. All associated risks, losses, and costs are your responsibility. The opinions expressed in this article are those of the authors and do not necessarily reflect the official stance of FX Street or its advertisers. The author bears no responsibility for information found at the end of links provided in this article. At the time of writing, unless explicitly stated otherwise, the author holds no positions in any stocks mentioned and has no business relationships with any companies referenced. The author has not received any compensation for writing this article, apart from that from FX Street. FX Street and the author do not offer personalized investment recommendations. The accuracy, completeness, or suitability of this information is not guaranteed. Neither FX Street nor the author will be liable for any errors, omissions, or any losses, injuries, or damages arising from the use of this information. Errors and omissions accepted. Lastly, it is crucial to understand that neither the author nor FX Street is a registered investment advisor, and nothing in this article should be construed as investment advice.